right. Hi, Patrice. Welcome.
Hello, everyone.
Hello
Pleasure
to
to be here.
everybody in the audience. It's great to have you here today because I think a big theme that we're seeing both at this conference today and in the market right now is the shift in leadership. The shift in leadership away from the US and into international markets. And you're an international and a global PM, as Maddie just mentioned. So you've been talking about this shift in market leadership for quite a while, and we're starting to see it unfold. So talk to us a little bit about the catalysts for why, and maybe some of the reasons why you think this can be sort of like sustained over a longer period of time.
Excellent. Well, thank you, Agnes, and great to be here with all of you at the really interesting time, I think, not only in terms of making sense of all of what's happening on a geopolitical basis, but exactly to your point, I think there's certainly a scenario, like at the minimum, where we are assisting to something broader underneath the surface of that volatility. I've been advocating for quite some time. You can look at the positioning in my global portfolio, which has been heavily tilted towards Europe, China more recently as well, at the detriment of having a fairly large underweight position in the US. And my thinking, and this is prior to what we're witnessing since the beginning of this year, but the thinking was that if you look at the main drivers of an economy, the consumer, the corporate sector, and the government, so the fiscal side, and you try to plot it on a cycle of where are we in that cycle. I think all of those elements for the US consumer was arguably overspending, fiscal deficit really high, corporate spending, especially with the boom around like technology and AI more recently. I think for the US, we were starting at, call it like a very elevated starting point. While when we go to Europe or you go to Asia, especially China, it was basically the mirror image of that, where in the case of Europe, like relatively depressed consumer confidence, high savings rates, deleveraging since 2013, real estate that has not picked up in over a decade, shock of confidence from the conflict in Ukraine, energy crisis, or what thought to be an energy crisis. So all of these drivers, don't know exactly where on the cycle they are, but in my opinion, we're much closer to a bottom than a peak. And then you go to China, and I think that's the extreme example where confidence like rock bottom, savings rates like literally through the roof since the pandemic and the closure of the economy that was much longer in that part of the world than it's been here, and certainly versus the US. Wealth effect shock from like the real estate slowdown. And for both Europe and Asia in general, it's not only the consumer that was starting on a very different sort of cyclical starting point, but it's also the government spending, where countries like Germany had been like very fiscally disciplined for forever. And they suddenly have that lever to pull on to absorb a pretty big shock that we're going through right now with tariffs and global trade. While there's not that lever in the US, actually, it needs to go the other way. And that's why we see tariffs. That's why we see DOGE, fiscal deficits, unsustainable in all likelihood. But ultimately, we don't buy the economy. We buy stocks. We buy the market. And I think all of that was further compounded by the fact that you compare valuations, you compare expectations for the US market relative to Europe or relative to Asia. And again, it was like the polar opposite not that long ago. Like effectively, I think we peaked on that in the days following the Republican election win, as the rhetoric of the market was all of these policies are going to be phenomenal for the US, will support this US exceptionalism that we've been hearing a lot, and will be terrible for the rest of the world. And to me, that just catalyzed. I've taken a very different approach on that. This, I think, will be good for nobody. But at least if you start closer to the bottom of the cycle with low expectations and low valuations, you're likely to be better protected than if you start at the other extreme. So that's why I've been advocating for international markets for some time. I think based on a longer term view of where stocks sit relative to their normalized mid-cycle earnings profile, I think it's much easier to find opportunities there that seems mispriced, that we can take advantage of. And that's why I've been taking advantage of even before the US federal election. And I think there is likely more to go because we just inflicted a pretty big shock to an economy that may be at a position cyclically that's a little bit less able to absorb that shock as opposed to Europe or China that can use government measures, fiscal measures to offset that. And I think the market is slowly starting to realize that. The sharp move of the first quarter is in a way not expected. When we see change in leadership in the market, it tends to happen quickly. It's quite abrupt. I think we've seen that in the first quarter. But I think for reasons I mentioned and more that we'll go through, I think that has the potential to last more than just 4 or 5 months here.
Okay. So you mentioned we don't buy the market, you buy individual companies. I think two of the biggest bets in your portfolio right now, Europe and China. Let's start with China because you're heading there. Dan Dupont mentioned you guys are off to China and Japan tomorrow. So tell us a little bit about that trip and who you're going to see and sort of what are you expecting or hoping to get out of that?
Great. So obviously leveraging the internal resources that are at our disposal in terms of a research team, local portfolio managers all across the globe, sitting with them in offices, but also visiting companies either through conferences, through our different offices, going to see them at their headquarters. It's just steady part of what we do, what I do. Like it's a big part of my time that's spent traveling. This time I have Dan joining me, but we'll be joined with our colleagues across Asia for a week of meetings in Tokyo and a week of meetings in Shanghai. We're back for a week, going 2 weeks in Europe. This is a little bit extreme, but it's very much part of the process. So why do we do that? Usually it's a combination of being immersed, not only like from a geography perspective, but immersed, surrounded by our colleagues that breathe this like in and out every single day. So to do the work that I would be doing here in Toronto, but from a desk in our Tokyo office or Shanghai office. So that helps analysts get more familiarity with what we're looking for. They're curious into my global views. I'm curious into their local perspective, and ultimately making sure that I know what their best ideas are and that they know what type of ideas I'm looking for. This is on leveraging our internal resources, but it's broader than that. Next week, Monday, as an example of the kind of doors that Fidelity can help us open, we have a meeting with the Japanese Ministry of Finance, and we have a meeting with the central bank. And this is not a meeting that's open to everyone, like hundreds of investors. This is for us. There will be like a handful of people meeting with those very important institutions. So why did we ask to go visit the central bank, for instance? Is we typically take a view of what may look interesting from our vantage point. And then we drill with as many resources as we can, trying to form a better educated view than most. So obviously I'm not going there thinking they will tell me where the reference like interest rates will be a year from now. They cannot tell us that. They probably don't know themselves. But to meet companies, majority of cases, or central bank in that case, a lot of what we do is trying to understand their analytical framework. What are they looking at and how will that influence their decisions? And I'm going with the perspective that inflation has been running higher in Japan for quite some time, part of which is because the labor force is now shrinking, so it creates wage inflation. And we're coming from literally decades of deflation, where the expectation around interest rates is anchored to really low levels. And the financial sector, notably the banks, if we get a sharp increase in interest rates versus expectations, could lead to some very meaningful earnings upside in terms of expectations trajectory. And our job is always to look where our market expectation, where our stocks price relative to that, and if we can find a delta on either valuations being very out of whack, usually for sentiment and positioning reasons, or more interestingly, if we can find situations where earnings expectations, at least over the midterm, are misaligned with a likely scenario, this is what we try to take advantage of. And next week is just one example amongst like many on any given year where we'll try to do that on a specific country sector and put all those resources to work.
And when you go to China, is there specific companies or sectors or industries there that you're interested in, or is China more of a broad story?
Yeah, so if you look at my portfolio positioning, China is one of the, not the largest, but one of the important source of conviction overweight position into the funds. But to your question, it is not broad at all, actually. It's very targeted. And in my opinion, where the opportunity lies today in China is on the Chinese consumer. I was mentioning earlier, following the pandemic, this economy has been closed for a period of time, and there was never a resurgence of confidence at the consumer level. There was a wealth shock from what happened to real estate. We seem to be bottoming. Part of the meetings we'll have next week or 2 weeks from now in China will be to gain like further conviction, talking to expert companies or analyst team on what's their level of conviction that this is indeed bottoming or not. But just to be crystal clear, I'm not like an uber bull on like a recovery of infrastructure spending, real estate spending in China. I think that was the economic model to support growth going back like 10, 15 years ago. They've moved from there. I don't think that's what they want either. If we go back over the past 5 to 7 years, it's been much more emphasis on developing their manufacturing sector, bring a lot of their companies that were, call it lower on the quality spectrum, and really move that up and catch up to Western standards for a variety of products. In some cases, arguably like passing a lot of us on, like the example of the electric vehicles is used a lot, but in reality, it goes much broader than that. But to some extent, that was the story of the past few years. We talk a lot about it now, but I think it's fairly well represented. I think the story of the next, call it 5 years more or less, will be that continued push on the Chinese consumer to regain confidence, move past like the real estate shock, and get that consumer, especially in tier 2, 3, 4 cities where there's like close to 1 billion people living there, that they're still very much like emerging in terms of like spending behavior. And if we can buy companies that will benefit from that at a time like right now or last year, where sentiment towards those companies was very depressed, valuations very cheap, and you can find some domestic leaders that have the potential to turn into like global leaders in some cases. That's been a lot of my focus for that part of the world, and very much the focus today still, not China broadly, so I wouldn't just go buy like a basket of Chinese stocks or an index. If you can focus on the upcoming like global leaders within that in the consumer sector, I think there's some really interesting opportunities.
What's a good example of a company in your top 10?
Yeah, so in the top 10, you'll find at the top of the portfolio, you'll find Alibaba and Prosus. Probably all of you know Alibaba, Prosus, maybe a little bit less, but probably all of you have heard of Tencent. So Prosus is a European holding company that was a very early investor in Tencent, and where the majority of their value of Prosus is the value of their stake in Tencent. So why buying Prosus as opposed to Tencent? I think that we'll talk again on trying to be, in a way, like creative, or try to find like other sources of value creation where I like the Tencent story, but buying it through Prosus, we get it at the meaningful discount, and a discount that's being addressed through essentially like the company buying back their shares at that significant discount by slowly selling their Tencent share and doing it in a very accretive, value accretive way of doing it. Why Tencent or an Alibaba? I think like global leaders into like domestic leaders into their domestic consumer market. And it goes and catch all of what I've talked about. But obviously, it's not only that macro view, it's a lot of the work on what has been priced in terms of revenue growth, compounding algorithms, margin trajectory. In these forums, like this discussion we're having right now, I find like most of the time we talk at a high level because this is what resonates, what people can relate to. the reality of our work on a day-to-day basis is really drilling down into the details of companies, trying to understand what are the growth opportunities for each of their divisions, what the profitability potential. In my case, being a longer-term investor, thinking on really like normalized earnings power of companies, what does that profitability profile look like 5 to 10 years out for these companies, and how cheap are they on that longer-term earnings trajectory? And I think both of these companies are some that I think, given the dislocation we've seen over the past few years, where we've moved from an environment where a lot of people, a lot of investors in the Western world thought of China as being to some degree like uninvestable. This is not the first time we hear that about a geography or a sector. It tends to create overreactions. We can talk about investment style later, but I'm a firm believer that the markets are efficient but overreact to trends that become very well accepted, recognized. And I think China has been one of those that brought meaningful opportunities, and that's why we've moved into a meaningful way.
We have a question here from the audience. What market cap ranges are most attractive to you right now? Small, mid, or large?
Yeah, so I think what's important to understand on the strategies, the portfolios I manage, is I have a lot of flexibility, as per the name implies, right? They're relatively concentrated portfolios. We will identify not only the countries, the sectors that seem like most dislocated, where we find those opportunities, but we're also able to navigate on the entire market cap spectrum and able to navigate even between styles, right? There's always a very strong sort of discount to intrinsic value that I'm looking for. So in general, it screens more value. But there are times, we've not seen that time in a while, but there are times where growth can be discounted versus its intrinsic value. So I'm able to navigate on all fronts. On market cap specifically, I would say in general, it is easier to find stories that are dislocated, misunderstood, maybe overlooked when we go into the smaller part of the market. So in general, the portfolios are a little bit more evenly split between small, mid, large, and mega caps, which again is very different than buying indices on Europe or Asia, where by definition you'll skew very large market caps. And why am I usually more interested in companies that broadly fall in that sort of 5 to 50 billion of market cap? It is not only that they can be overlooked and maybe more likely to find some that are misunderstood, but it's also you can target more precisely. When you buy a mega cap company, by definition, they will almost in all cases be very diversified. They will be global multinationals, a lot of different product lines in a lot of cases. So if we try to build an exposure to, let's take the case of Europe right now, I think there's an interesting idea that's developing that we could assist to a recovery of construction activity across Europe. On one side, from reconstruction of Ukraine, I can't tell you when it will happen, but hopefully it happens at some point. A lot of signs that we're potentially moving closer to that point that could tighten up capacity for construction. On top of that, we were talking about German fiscal spending, a lot of that is going to defense. The market understands that really well today. The stocks have moved materially. But some of that could also be directed towards infrastructure, towards residential real estate. They have the same shortages we have here, if not even magnified. And if we want to look for reconstruction or construction exposure, the reality is not always easy to be really exposed to that. Let's rewind the clock back in Q1, where there was a lot of talks about ceasefire in Ukraine. All the large investment banks created some baskets of European reconstruction or construction exposure. And one thing that we did, actually, Connor and I were sitting across from each other, both working in global mandates. We picked those baskets from Goldman Sachs or Morgan Stanley, and line by line, okay, this company, 20% of the business is exposed, 10% of the business is exposed. Let's really go find the one where 60% of the business is exposed to that. And usually, if it's to pick an exposure, it's easier to achieve that greater exposure to a more targeted, more domestic which is usually more smaller or mid-cap. And that's why the portfolios are often built this way.
That's good to have that flexibility. Let's continue with Europe, because you've mentioned a few things, maybe the reconstruction of Ukraine, fiscal spending. What companies do you like there? Where are you finding the best opportunities? What industries or what sectors?
Yeah. So to answer that question, it's always a combination of fundamentals and what's been priced in. So I'll give a few examples on some of those. So on the example of fundamentals, a lot of our work is to build a differentiated view around revenues and margin profiles. And one of these stocks that I can use that's in the top 10 of the portfolio is Airbus. We were talking about defense very briefly. A lot of the pure play defense companies have already re-rated very meaningfully. But if you can find some exposures that are discounted or you're not paying for, in a way I look at those as like free options or maybe unrealized potential into a stock. So the shorter term change at Airbus is it's also the largest defense contractor in Europe, and they will benefit like Rheinmetall and others will to a lesser extent. But the core of the thesis on Airbus has nothing to do with defense. The core of the thesis is we are assisting since a number of years, since the recovery from the pandemic, onto basically a return of strong demand for travel. Airlines are looking to add capacity. There are 2 companies globally that can build those airplanes. The US competitor has gone through a lot of issues, leaving Airbus into a very good position. Fundamentals are supported by literally a 10-year backlog, so a lot of visibility on the revenues. I think that's well understood. I always like to talk about what is less well understood. And I think there's the case for a margin improvement story at that company, where as they ramp back up production, the profitability they derive from building one more aircraft is much higher than the average. So there's a high level of incremental margins in the business. And as they are basically looking to ramp production, especially of the 320 series of aircraft, we should assist to a meaningful growth into the profitability of that company, which in our opinion is maybe not fully captured by the market. So a lot of the thesis will be, yes, supported by a macro view, but really going down into the details. Another example of exposure to Europe that we've been building for some time here is around the tourism industry, where I think we are assisting to very good demand at the moment. This is despite the Chinese cohort of travelers not being fully back in Europe, and maybe fueled with the shorter term events by a little bit more of a nationalistic approach to where is a lot of people looking to travel. So looking at adding exposures, again, sometimes on higher quality, indirect ways, but we'll own a company that is a software provider to booking systems of airlines and hotels. We have the low cost airline of Europe, like Ryanair. It's disclosed into the holdings. Looking more recently at very domestic, European-centric, hotel chains that might benefit from that, and where, again, it's not all reflected into the share price. And maybe a story of the past few years that you'll understand how it played out. And for full disclosure, this is an area that is still important, but has been reducing over the past, especially over the past quarter. But European banks, where we've built meaningful exposure going back 3-4 years ago when interest rates were still negative, were taught to stay negative for a very long time if we go back into the aftermath of the pandemic. And as I mentioned with Japan, it's absolutely the case. Anywhere in the world, banks are dependent on the interest rate environment that will dictate their net interest margins, will dictate profitability, return on capital, et cetera. And Europe, it was very depressed. Let's go back to the framework. I think a lot of trends are following cycles, including interest rates. And I took the view that rates at that negative territory are probably unsustainable. I think it's hard to debate that, especially a few years after. But it shows the markets will overreact. The markets will assume this is the the new constant, and we'll price that in. And that's what creates a lot of opportunities, taking advantage of those overreactions. We've done that in a meaningful way on European banks a number of years ago. I think the story of higher interest rates as renormalized, I don't think we have as differentiated of a view on that as it stands today. But there's another element where, back to the European consumer that's been deleveraging for 12 years, the banking sector has seen no loan growth ever since 2013 in aggregate. And if we start to see confidence coming back, the deleveraging having run its course, construction, residential activity picking back up, we could assist to like a recovery to more normal growth into mortgages, into like auto loans, etc. And this, I think, is still not very well understood by the market and leaves some opportunity to have that as a potential source of upside surprises on these stocks from a fundamental standpoint.
It's clear that we have a lot more we could talk about today, but unfortunately we are at time. But what I would just say, and sort of my observations from this conversation, is as investors look to reduce concentrations in their portfolio, there is an abundance of opportunities outside of North America in global and international markets. And I think that you're well suited and well positioned to find those opportunities. So thank you so much, Patrice. It was wonderful speaking with you today.
Pleasure to be here.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.